Many traders prefer to get involved on lower time frames and to make quick profits scalping forex and stock market. Others are price action traders, reading the markets and making trading decisions based on recent price movements, not relying on technical indicators. But can you combine both, scalping and price action? Sure you can. And in this video I'm going to show you a simple price action strategy to scalp the lower time frames. Strategy which involves a trend line and a double top or a double bottom pattern. Just as the name implies, this price action pattern involves the formation of two highs at a critical resistance level for a double top, and the formation of two lows at a critical support area for a double bottom. The idea that the market was rejected from this level not once but twice is an indication that the level is likely to hold. A double top pattern is where price fails to break a previously established price level. This indicates an area of resistance where sellers overwhelm the market. As a result, the buyers eventually give up, leading to a double top pattern. A double bottom pattern is exactly the opposite of a double top. Here, price initially forms a low, then bounces back. Following this bounce, price once again tests the same level, but fails to break any lower. The double bottom pattern indicates an area of support or demand where buyers overwhelm the sellers, leading to price forming this pattern. A validation of these patterns signals a reversal in the price direction. When these patterns form, it tells you that the market momentum in the direction is stalling. When price fails to make any fresh lows or highs, but closes at or near the previously established high or low, a double top or a double bottom pattern is formed. In this 1-minute chart, you can notice that after the double top pattern is formed, price tends to eventually move lower. And here you see the double bottom pattern that emerges. A successful formation of this double top or double bottom pattern results in a change of price direction. Now here's an important point. Not all double top and double bottom patterns are perfect. It is very rare to find price forming a pattern at exactly the same price level. A more common pattern is the double top or double bottom with a fake breakout, especially on lower time frames. Fake breakout patterns are one of the most important price action trading patterns to learn, because a false breakout is often a very strong clue that price might be changing direction or that a trend might be resuming soon. A false breakout of a level can be thought as a deception by the market because it looks like price will make a strong move in one direction, but then it quickly reverses, deceiving all those who took the bait of the breakout. It's often the case that amateurs will enter what looks like an obvious breakout, and then the professionals will push the market back the other way. As a price action trader, you will want to learn how to use double tops and double bottoms false breakouts to your advantage, rather than falling victims to them. One common misconception is that the double top or double bottom patterns become tradable once the second top forms. The truth is that double top or double bottom is only confirmed and therefore tradable once the market closes below its neckline. This is the intermediate high in the case of a double bottom pattern, or an intermediate low in the case of a double top pattern. When this reference point is breached, you can expect the pattern to be validated. Once the pattern is formed, price now changes direction. When you combine these patterns with the concept of trends, this approach will be even more powerful. Now that we have an understanding of the double top and double bottom patterns, let's see how we can apply this to scalping. Most trading books teach you to trade double tops and bottoms as reversal patterns. I prefer to do the opposite. I trade them as continuation patterns. A double bottom or a double top, when formed within a trend, can signal a continuation. For this approach, determine the main trend on lower time frames and plot a trend line. An upward trend line when you see higher highs and higher lows, and a downward trend line when the market makes lower lows and lower highs. Now you need to identify potential setups such as the double bottom or double top pattern that can occur close to that trend line. When this pattern emerges, you can be confident in trading in the direction of the trend. So in the case of an upward trend line, you search for double bottoms near that trend line. And conversely, you search for double top patterns near a downward trend line. Let's look at an example of a long setup. In this instance, we identified a rising trend line on the 5-minute chart, and we waited for the price to post a double bottom pattern. This pattern forms right near the trend line, increasing the validity of the double bottom pattern. Since we already know that the price is in an uptrend, the validation of the double bottom pattern off the trend line increases the odds of this setup being successful when compared to trading it in isolation. You enter once the price breaks above the neckline of the double bottom. Now, the first thing you need to know is that the initial breakout is not what triggers the trade setup. What we need is a retest of the neckline as a new support. This ensures a favorable risk-to-reward ratio, which is an essential factor if you wish to succeed when scalping. Notice in this example how the market retests the neckline as a new support. This is where we now have an opportunity to go long. A potential profit target is made by projecting the distance of the double bottom to the upside. You simply take the distance from the double bottom resistance level to the neckline and extend that same distance beyond the neckline to a future upper point in the market. You don't necessarily need to wait for the double top or the double bottom patterns to form right near the trend line. These patterns can appear at any point in the uptrend or the downtrend. The key thing to remember is that the trend line still remains intact and that price has not deviated too far away from the trend line. This is because when price deviates far away from the trend line, it can revert to the mean or snap back to the trend line. This can reduce the odds of the double top or the double bottom pattern being a successful trade setup. Here are other examples of valid double bottoms near upward trend lines on lower time frames. The second scalping scenario involves a downward trend line and a double top on lower time frames. So let's analyze this example. We have a downward trend with a bearish trend line. The price creates the first top and then makes another top. Notice that the created pattern is near the main trend line and doesn't go through it. We plot the neckline on the bottom between the two tops of the pattern, and you go short when you identify the breakout and the price retests the neckline. Needless to say, you should always secure your open trades with a stop-loss order, because there is never a guarantee that the trade will work in your favor, especially when you're scalping. The optimal place to put your stop-loss order is just above the second top. If you want a better risk-reward ratio, you could set your stop-loss closer to the entry point. For example, you can put your stop-loss at another smaller swing point or a candlestick high, which comes after the second top. If the price move after the neckline is consistent with no corrections, then simply measure the distance between the second top and the trigger line and place your stop-loss in the middle. It might be a better risk-reward solution for the double top and double bottoms. This way, you get at least 1 to 1.5 risk-reward ratio. After setting the stop-loss, you measure and apply the size of the double top pattern as your target. So the minimum target equals the size of the pattern. Now here's a very important point. A double top pattern without the close below the neckline, it's not technically a double top. Unless the neckline has been broken, this is not a valid setup. It could be a consolidation, a ranging price action. The main thing to remember is that no double top is completed until the market closes below the neckline. Not only is not completed, but attempting to enter before having a confirmed setup can get you in a lot of trouble. Perhaps the most important aspect of a double top is to avoid entering before confirmation. Wait for the support to be broken in a convincing manner and usually with an expansion of volume. You can pay attention to volume to get an extra confirmation that the breakout of the neckline has some momentum. Here are several valid double tops near a bearish trend line. Most traders use indicators for scalping, and there is nothing wrong with this approach. The problem with indicators is that they lag behind price, and scalping trading and lagging behind price just don't mix well together. Scalping requires quick analysis, quick decisions, and quick trading. That's why price action represents a good fit for scalping. At its core, price action trading is all about speed and efficiency, and might bring better and more consistent results in the long term. As always, if you learned something new and found value, leave us a like to show your support, subscribe to our channel and hit the bell icon to stay notified when we upload new videos. Until next time.